Hey guys, it's Jason.Irwin from Engel and Völkers, Scottsdale. And today we're going to talk about mortgage rates, the market, but from a lender's point of view. So, I've got to tell you guys, lately I've been getting a lot of emails and calls from clients with the rates going up, where they think it's going to go. And you guys, everyone knows that I think the rates are going to go up to about 7%. But I'd like to introduce to you James McKinnen from Movement Mortgage, lender that I use personally. And I thought bringing him today to give you his perspective from a lender's point of view would give us a new direct, a little bit more different point of view. So, James, welcome.
Thank you, guys. Thanks, Jason, for having me. Really appreciate it. So, from a lender's perspective, I can go over a lot with interest rates. So, from a rate perspective, I can go over this very in-depth, I should say. I've been tracking mortgage rates for about 15 years. One, when someone's looking to buy a home, they want to have a lender that understands the markets, that goes deeper than just looking at their rate sheets. So for myself, I follow the mortgage market guide. Some will follow what's called like the MBS highway or like Mortgage Daily News. There's a lot of science to interest rates. It's not just pricing a loan out or looking at a rate sheet. You really have to know what the driving factors are. So if we go back, the reason why rates were so low is that the Fed they were buying, they were essentially artificially keeping rates low. They were buying mortgage-backed securities, treasury securities, mortgage bonds, and essentially that was helping securitization on the secondary market to keep rates low. They came out kind of end of the year, said they were going to start to taper. Tapering meant pulling back, kind of going back to quantitative easing. So when they started tapering, and instead of buying, I think, 120 billion at the height, which was keeping rates so low, now they're buying maybe 40 or 50 billion. So right there alone, when you lose that securitization on the secondary market, rates rise. When you also look at it from other fundamental reasons, if you look at, the Fed meets 8 times a year, the Federal Reserve. It's a committee of 12 people, and the Fed has boldly stated they're going to raise rates this year. The next kind of mark on the calendar is the May 5th meeting. The Fed is probably going to raise, I think the projections are there's an 87% chance of a half-point raise here in about a week. And that's going to go up a half point. That's tied to short-term rates, something up to 0.75. So the one thing to keep in mind with that is that if you look back, we kept hearing about the inverted yield curve. The inverted yield curve essentially means that, what it means is that long-term rates were lower than short-term rates.
Correct.
We have to see if that's going to flip a little bit based on what some of the indicators are telling us. So when we see short-term rates go up, those are tied to lines of credit, certificates of deposit, car loans. It doesn't always have a similar direction. It doesn't always have correlation with long-term rates. However, it has played that part lately. So that was just kind of a snapshot of what, if you're a buyer, what you want to look at is make sure your lender understands rate movement because it's going to be shifty. The other thing is make sure that you're in the right product. Is there a product that's better, well suited for you? Maybe you have a banker who's pushing you into one loan when really you shouldn't be in that product. That can also free up some rate, love for you per se. I think the other thing is if your credit score is not at the highest bucket, maybe you're at 709. Rates improve with each 20-point mark essentially. So 700, 720, 740. So we're also doing a lot of rapid repair and rescores to get credit to that little bit better bucket. That's going to give you a better rate. So I'm giving some of the science behind what comes in from an interest rate perspective. Going back to your more direct question, what are rates going to do? If you look back to the head economist of NAR, the National Association of Realtors, he had projected, Dr. Lawrence, he projected rates were going to be 3.75%, as well as most experts, by the end of 2022. Obviously, they've blown way past that. So I think it's very telling that it's hard to project exactly what rates are going to do. There's so many factors with potential chaos abroad, wars per se. The stock market, I think we're down now 11% really this year. Those are huge driving factors. How do they all, kind of tie into what's going to happen with rates? We look at the 10-year Treasury, it almost hit 3% last Friday. Then we saw a little bit of love the last 2 days. So it is kind of like this. We also have to look at with margin compression. are lenders going to start to, move margins to free up price to sort of try to drive, products back? We're seeing also a huge shift in layoffs with lenders where those all play factors in terms of your overhead and kind of the company P&L. I think rates have sort of settled, and per the experts, my kind of median perspective would be that we're probably going to see rates up 1/4 to 3/8 by the end of the year. I don't think we're going to see things, and of course there's too many driving factors, there's no crystal ball, but I think they've kind of settled from the perspective of not going up as fast as they have. We've just seen the largest 3-month rate spike since 1994. So we've seen the really abrupt kind of detail there, but it also gives us the chance to educate clients on looking at the last 10 years, 20 years. Rates are still very low. The other thing to consider is that interest rates dropped in 2012, 2016, 2019 substantially. So there was spikes in between those years. So this purchase market that we're seeing, even though there's low inventory, there could be another refi boom created from it in 3 or 4 years if the last decade will repeat itself. So don't think your forever loan is going to be your forever rate. Almost see it as an A-paper bridge loan. Every single indicator shows values going up 10 to 20% in the next year or two. That's massive. Buy a home, appreciate with the market. Maybe your rate's a little higher than it was 6 months ago. But look at an exit strategy. Talk to your lender. Once you own the home, look at a refinance. Maybe you can time the market with a rate drop, because it's going to happen. So even a 1/2 point drop from right now, it creates a whole new refi market with low closing costs. So talk to an expert. I'd love to help you. I've been doing this a long time, and I really follow my charting. I do a lot of reading, and I can probably give you more perspective and kind of the philosophy behind interest rates than most lenders can.
Well, that leads me to my next question is everything you just said right there, and there's a lot of factors that are in the world going on right now. Have you seen a change in the mortgage loan apps? Have you seen a change in that sector, as far as people looking to get loans?
It's a great question. The market really hasn't slowed down. If you look at the local market here in Phoenix, right? I believe in the greater Phoenix area, there's about 5 million people that live here. About 5 million and about 1.5 million homes. We're in Scottsdale today. And there's about 5,000 or maybe 4,500 homes for sale. So the inventory is so low that even though rates have gone up, give or take 2% in the last 120 days, it's not slowing down these buyers. I think that they have to look at some of the factors that offset. Rents are up about 20% nationally over the last 12 months. People are paying so much more. You don't get the write-offs. If you own a home, your mortgage interest is tax deductible, up to a $750,000 loan or $10,000, one or the other. So if you look at all these advantages with buying and what the forecasts are telling us, people have almost shifted the mindset of maybe we should wait and see what rates do and see if they come back down. 2, we better hurry up and buy so rates don't go up further. If you have the right loan officer and realtor team like we are, educating you, and you look at those and you have those rebuttals based on data that are really data from the greatest experts that run these billion-dollar hedge funds and corporations, you can really start to have comfort in buying a home today, even though the payment's a little higher than it would have been. You have to look at, there's no homes for sale, and we're seeing 5, 10, 20 offers on every home. It's going to lead to values going up. I think it also comes back to positioning clients into the right product.
Correct.
We have to look at maybe lenders don't have a program where where the client would get a much better deal. We're seeing more ARM loans coming back, so like 5, 7, and 10-year fixed period ARMs. These were really popular before 30-year fixes were so low, where it just didn't make really much sense to do an ARM loan. But we're seeing those come back because if you have a 7-year fix, let's say as an example, 84 months is a long time to have a fixed rate, where we probably will see rates fluctuate back up and down a few times. And with values going up, you're going to be getting more equity. It's also going to enhance and optimize your pricing. Just because the more equity in your home, rates are always an assessment of risk. So the more equity, the better the deal you get. Right. So I think it's about having a real expert, which is I think going to be the norm, is you're going to see more expert loan officers on more deals because in a certain way, you're going to see more people probably leave the business. It's just been a situation where if you were all refinance, we're shifting the market so quickly that it's hard for someone to go out and obtain a whole new book of referral partners overnight. And so I think with rates where they're at, even going up a 1/2 point or a point, I don't think it's going to slide on the market too far based on all the positives that come with home ownership.
Good, and that's kind of that goes along with what I've been letting my clients know.
Yeah.
Is I don't see much change with the rates going up where they are, because historically they're still low.
Yeah, they really are.
But saying that, I could sit here and talk to you for hours about this. I definitely want to bring you back.
Thank you.
Thank you for coming out. Guys, if you have any questions about anything we talked about today, obviously you can call me, email me. I'll also make sure I include James's contact information at the bottom of the transcript, so you can contact him as well. Otherwise, I'll see you next time. Thanks, guys.
Thanks, Jason.